Next, on December 31st, an entity analyzed a finite life trademark, a trademark with limited life, with a net carrying value of $750,000. Net carrying value, sometimes called the book value, for impairment. This is the book value of the trademark, an intangible asset. The entity determined the following: fair value 700, undiscounted future cash flow is 740. What is the impairment loss that will be reported on December 31st income statement under the US GAAP? Under the US GAAP, impairment loss is a two-step process. In step 1, you compare your book value or the carrying value, which is 750, with the undiscounted future cash flows. Mind the word, undiscounted future cash flow 740. If your book value is more than the undiscounted future cash flow, that means impairment has to be recorded. And what is the impairment? That is the second step. Impairment is calculated by comparing your fair value with the book value, also called the carrying value. So fair value happens to be $700,000 and book value is 750. Clearly, your book value is more than the fair value by $50,000. So the question says, what is the impairment loss? The impairment loss would be $50,000. And what would be the new basis on which you are going to report your intangible? The new basis would now be $700,000. So that is D. D is the right option. Next, Dawson Corporation uses the last in, first out perpetual inventory method. I'm sure you know what is perpetual. Every transaction, sale and purchase, must be matched date-wise. During the last in, first out perpetual, during the first 6 months of operation, first 6 months means there is no opening stock, Dawson made the following purchases and sales of inventory. Purchases: January 1st, 40 units at the rate of 110 each. February 15, 60 units at the rate of 115 each. And these are the dates of purchases and these are the dates for sale. What we need the cost of goods sold. Cost of goods sold, you sold 25 units on February 1st. There is no opening stock. You are using last in, first out. So these 25 units would be sold from your latest purchase, and your latest purchase by February 1st was on January 1st. So you sold these 25 units from this lot, which has a cost of 110. Then you sold 40 units on 15th of March. These 14 units would be sold from the latest purchase. And what is your latest purchase by 15th of March? Your latest purchase was made on 15th of Feb at the rate of 115 each. So you sold 40 units at the rate of 115. We need CGS, that's why I've just taken these units and multiplied their relevant cost with it. So if you do, it's going to be 2750 for the first item and 40 times 115, that is 4600. So the total of these will be 7350. This is your cost of goods sold under the life of perpetual. Now listen, if the question asks you what is the closing stock under LIFO, closing stock, out of these 40, 25 have been sold, so there are only 15 remaining at the rate of 110. Out of the 60, 40 have been sold, only 20 remain at the rate of 115. And these 75 units are totally untouched. And when you will multiply and add up all, this will give you the closing stock. Now, moment, if this question was solved using LIFO periodic, please listen, LIFO periodic does not care about the dates. LIFO periodic does not care about the dates. It will simply care how many units did you sell. You sold a total of 65. How many units did you buy? 40, 60, 100, 175. So, under periodic, we do not care about the date. Under periodic, we see how many units we had, how many we sold. We sold 65 units. Now, these 65 units we sold. Under periodic, all of these will be sold out of the 75. All of these 65 units would be sold out of these latest purchase at 125. That is the way of doing periodic. And this is mostly you are tested on your exam. And if you are asked what is the value of closing stock under LIFO periodic, you would say out of these 75, 65 have been sold. Only 10 units remain at the rate of 125, 60 units at the rate of 115, and 40 units at the rate of 110. A firm performs IFRS revaluation of all of its fixed assets. Remember, revaluation is not allowed under the US GAAP. Assets are to be reported at original historical cost. So a firm performs IFRS revaluation of all of its fixed assets at the end of the current year with the following carrying values and their fair value. Buildings had a carrying value, book value of 62, market value is 58.4. The difference is 3.6 million, and this 3.6 million will be a straight loss to your income statement. Loss to the income statement. Equipment had a carrying value of 13.5 million. It has a fair value of 12.8 million, and the difference is the difference is $700,000. This is again revaluation loss. It will be charged to the income statement, right? Land 94 million has a fair value of 97.1 million. It appears there is a gain 3.1 million, and please note this gain, how do we treat it depends upon what is the information given. If the firm recorded a 1.2 million revaluation loss on its land during the prior year, previously we already wrote off this loss on land during the prior year, what is the total net amount from the revaluation of all fixed asset classes reported in other comprehensive income for the current year under the revaluation model? Now, since 3.1 million loss gain for the period, this gain first must be offset against the previous loss. So what you're going to do, yes, 3.1 million gain is there. It must be offset against the previous written off loss of 1.2 million, and the remaining gain, 3.1 million gain less 1.2 million previous loss will be netted off. Now the remaining gain of 1.9 million, this goes to other comprehensive income as a revaluation surplus or as a revaluation reserve. Remember, if there is a revaluation loss, it goes straight to the loss as an income statement. But if there is a revaluation gain, you need to see if there is any previous loss must be netted off. Remaining gain should be taken to other comprehensive income, because this gain cannot be reported as a part of your regular income statement. So that will give you 1.9 million, and this will be reported as a part of other comprehensive income, that is C. Next. When using the indirect method to prepare the statement of cash flows, net cash flows from operating activities are determined by adding back or deducting from net income those items that had no effect in cash. Depreciation, discount amortization, premium amortization, loss on disposal, gain on disposal. Many non-cash transactions are adjusted in your net income. I'm sure you know from your cash flow statement topic. Which of the following items should be deducted from net income when determining the net cash flow from operating activities? You start from your net income and you make certain adjustments, certain addition, deletions. First, item 1, an increase in accrued liabilities. Increase in accrued liabilities means you withheld payment to your suppliers, delaying your accrued liabilities, the payment being delayed, effectively it's an inflow. It is added to the net income. A loss on sale of plant asset, loss on disposal, it's a non-cash loss, must be added to your net income. A decrease in your account receivable. A decrease in your account receivable means your customers have paid you. When your customers pay you, that increase your cash balance, so it must be added. So A, C and D must be added. Bond premium is amortized. It's a non-cash transaction affecting your income statement. It's a kind of gain and it must be deducted. If it was amortization of bond discount, remember, bond discount is added. Amortization of bond premium, it is deducted. This topic relates to your cash flow statement, and if you have read the topic well, you would know what exactly I'm talking about. Next. Rainbow Writing Center provided Lewis accountant with the following information related to the current fiscal year. We have been given the revenues, we have been given the stock issuance during the period, liabilities at the end of the year, shareholders equity at the beginning, shareholders equity at the end, dividends paid during the period. Calculate the net income of Rainbow Writing Center based on the information provided. Net income. Net income, we can't take revenue because for that we need expenses and other gains and losses. We don't have them. Another way to do it is to take the opening balance of your shareholders equity. To this add any share issued during the period, which we have. To this add any income earned during the period, which becomes part of your retained earning, and if any dividend has been paid, deduct the closing balance should come from these 4 items given, or 5, whatever the numbers might be. So I've taken these because they are available at the moment. So your opening balance of shareholders' equity is 25,000. The shares you issued during the period were 10. They will increase your equity. We earned a certain income X. We don't have, right, X. And we have paid $7,000 as dividend. So these 4 gives you a net of your closing balance of equity as 57. Make X the subject of the equation. X is equal to 57 plus 7 less 10 less 25, a simple arithmetic, and it should give you the income earned during the period. So it's going to be 57 plus 7 minus 10 minus 25 will give you 29,000. 29,000 is the income for the period. That makes C to be the correct option. Next. A company has outstanding accounts payable of 30,000. A short-term construction loan in the amount of 100,000 at the year end. Both of these are current liability without doubt to be settled within the next 12 months. The loan was refinanced through the issuance of a long-term bonds after the year end, but before the issuance of financial statements. So what happened? This $100,000 construction loan, which was a current liability, it was refinanced by issuing long-term bonds against it, which means it is no longer a current liability. Even it happened after the balance sheet date. But on the balance sheet date, there was some things going on representing the refinancing arrangement. So we are not going to show it as a current liability, even it happened after the balance sheet date. How should these liabilities be recorded on the balance sheet? So you're going to report 30,000 as a current liability and this 100,000 as a non-current liability. Even this refinancing arrangement was made after the balance sheet date, but financial statements have not yet been issued. Maybe they were issued in March or April, and it happened on 7th of January. So it's an adjusting event, means you need to revise your current liabilities and show this 100,000 as a non-current liability. That makes C to be the correct option. Next. Livery company purchased a machine that was installed and placed in service on January 1st, year 1 at the cost of 240,000. That's the acquisition cost. Salvage value was estimated to be 40. The machine is being depreciated over 10 years by the double declining balance method. The formula you can use to calculate the double declining percentage is equal to 1 upon life multiplied by 100. So is asset ki life, the depreciation is to be made over 10 years, so life is 10 years multiplied by 100. And if it is double declining, you need to multiply it with 2. So it means the percentage you're going to use is 20%. So double declining percentage is 20%. Question says, for the year ended December 31st, year 2, what amount should livery report as depreciation expense? For the first year, depreciation is going to be 240,000 multiplied by 20%, that is $48,000. For the next year, this is for year 1. For year 2, it's going to be 240,000 less the depreciation already made multiplied by 40%. So it's going to be 240 less 48,000 multiplied by 20%. So second year depreciation will be 38,400. First year depreciation is 48. Since we are required to find for the second year, it is 38,400. B is the answer. Next. Now this question is little tricky. Livery company purchased a machine that was installed and placed in service on July 1st, year 1. Compare it with the previous question. It was January 1, year 1. Here it is July 1st, year 1. That is the end of 6 months. At a cost of 240, salvage value was estimated to be 40. The machine is being depreciated over 10 years by the double declining balance method. The question says, for the year ended December 31st, year 2, what amount should livery report as a depreciation expense? You should calculate the depreciation first from 1st of July till 31st of December, year 1. Then from 1st of January to 30th of June, year 2. And then from 1st of July, year 2 to 31st of December, year 3. Double declining percentage stays the same, 20%. So it's going to be 240,000 multiplied by 40%, that will give you 20%, that will give you 48,000. This 48,000 will be split into two parts. First part will be charged at the end of 31st December year 1 as 24,000. The remaining 24,000 part will be charged from 1st of January to 30th of June. Now listen, this is important. Now you need to calculate the carrying value at the end of June, that is 240,000 less 48,000 multiplied by 20% multiplied by 6 upon 12. That is for the period from 1st of July till 31st of December. If you do, it's going to be 240 less 48 times 26 by 12, that is 19,200. Now listen, since we need to calculate for the year ended December 31st year 2, it will involve January to June, July to December. The total of these two will be the depreciation for the second year, and it will give you a total of 24 plus 19,200. It's 43,200. That will make D to be the correct option.